Order flow trading is a relative new type of trading method which has become quite popular with traders over the last few years. It's a method which differs from other types of trading as it focuses less on understanding when something has taken place in the market and more on why something has taken place in the market. Today's video is just going to be a little introduction into what order flow trading is. I'll start by explaining what the core beliefs behind order flow trading are, and then I'll move on to showing you the differences between order flow trading and other types of trading like price action. What is order flow trading? In simple terms, order flow trading is a type of trading which focuses on the understanding how order enters the market via traders making decisions. Order flow trading itself is not a new method of trading. It's been around since the beginning of modern financial markets, just not in the format we would recognize today. The name order flow comes from the way buy and sell orders will flow into the market from different market participants making trading relative decisions like placing trades, closing trades, and taking profits. In all other financial markets, order flow trading will be conducted using an indicator called the order book. The order book is a trading indicator which gives the trader using its huge amount of information about the buy and sell orders that are entering the market from different financial institutions. It shows the prices which the buy and sell orders are being placed, at which type of orders are actually being placed, pending orders or market orders, and also how big the size of the orders are. For the people who have access to it, the order book provides a sizable advantage over other types of market analysis, although, as with anything in trading, it does require a significant amount of training in order to learn how to use effectively. The difference between order flow trading and other types of trading. I think it's important to just have a quick run through the difference order flow trading has with other types of trading, so as to make it clear what order flow trading is and isn't when compared to things like price action trading. Order flow trading is a type of trading which is similar to price action trading in the sense they both propose analyzing the market in a certain way. Price action traders believe in analyzing the market price to determine which direction the market is going to move in, while as order flow traders believe they can predict where the market is going to move by simply understanding the actions made by the traders in the market. How does order flow trading work? The idea behind order flow trading is that if you understand when you and where traders are likely to make their decisions, you can determine with a large degree of accuracy which direction the market is going to move in. The reason why is because whenever a trader makes decisions like place a trade, close a trade, etc., they put an order into the market which has potential to cause the price to change. One order on its own is not enough to cause a price change, but thousands of dollars of orders all coming into the market at the same time can cause the price to change. So the basic goal of an order flow trader is to understand how other traders in the market trade, as that it will allow him to figure out when a large set of orders are likely going to come into the market and cause price to move up or down. Now, figuring out the trader's trade is quite difficult due mainly to the fact there are so many different trading strategies out there which people use to trade the market with. Luckily, we don't need to know the specifics of the trading strategy people use. All we need to know is what is the basic goal of their trading method is, and from that we can work out when and where they're going to make a decision which will put orders into the market. There are basically two types of trading strategy used by the tradings in the market: trend trading strategies and reversal trading strategies. Trend trading strategies are strategies in which the goal is to get the trader using them into a trading position after a movement has occurred in the market. A moving average system is a great example of this, as an averages only cross one another once the market has already spent some time moving up or down. Now, the goal of a reversal trading strategy is to get the trader into a trade before a movement in the market has taken place. Examples of reversal trading strategies are things like for candlestick patterns at support and resistance levels, or taking trades at supply and demand zones. Although both strategies are quite different to one another, they are essentially the same because they aim to get the trader using them into trade before movement has occurred in the market. So even though there are lots of different trend trading and reversal trading strategies out there, they are all basically different spins on the same formula. They're either trying to get a trader into a trade before a movement has taken place or after the movement has taken place. By simply understanding these two facts, you negate the need to learn about the intricacies of all the different trading strategies out there, because you already know when the traders using these strategies are likely to enter the market and get their trades placed, either before or after the movement has taken place in the market. How do the banks trade? Understanding how large groups of retail traders trade is one of the primary components of order flow trading, but you only need to understand how retail traders in the market trade, but also how the bank traders trade, as ultimately they will be the ones who cause the market price to move up and down. As you probably expect, the banks trade in a different way to how to use retail traders trade. Not necessarily in terms in which trading strategy they actually use, but in the condition that must be present in order for them to place trades or take profits. When we decide to place a trade, we never think about whether or not there are enough orders coming into the market for our trade to be placed. This is because we know we can place trades whenever we want. The reason this is possible is because we're placing very small trades into the market. There only needs to be a tiny number of buy or sell orders entering the market at the time we want to place our trade for our trade to be placed. Now, unfortunately, the banks don't have this luxury because the sizes of trades they're placing are much, much bigger than ours. They can also get their trades placed when there's a vast number of sell orders or buy orders if they were placing sell orders coming into the market. This means when you see an up move take place, the banks are unable to get buy trades placed or take profits off any sell trades because most of the orders entertaining the market are buy orders from traders placing buy orders of their own. What can they do to get sell orders placed or take profits off existing trades? As both of these actions require there is to be a large number of buy orders coming into the market. For down moves, it's the opposite way around. When the market is falling, banks can't get the sales trades placed or decide to take profits off any buy trades. They get to place as majority of the orders entering the market are sell orders from the people selling and liquidating losing buy trades. They can decide to place some buy trades into the market or take some profits off the sell trades they've already got placed, as they are two actions which can be complicated if there is a large number or sell entering the market. Summary. Order flow refers to the buying and selling of securities in a market. It represents the actual orders being placed by traders and investors as opposed to the final price that are reflecting on the charts. Order flow analysis is a technique used by traders to study the flow of orders in a market in order to gain insight into the behavior of other market participants and anticipate future price movements. There are two main types of order flows. Buying order flow. This occurs when there are more buyers and sellers in the market, resulting in an upward pressure on prices. Selling order flow. This occurs when there are more sellers than buyers in the market, resulting in downward pressure on prices. Order flow analysis can be used to identify key levels of supply and demand, which can provide insight into the strength of trends and potential reversal points. Traders can use this information to make more informed decisions about entering and exiting trades. However, it's important to note that the order flow analysis is a complex and advanced technique that can be challenging for novice traders. It is best used in conjunction with other forms of market analysis and risk management strategies. In my opinion, having a good understanding of order flow trading is essential if you want to become a really good trader. Price action trading and other types of trading can only get you so far. Order flow trading gives you the extra level understanding which allows you to have a much better grasp of what's actually going on in the market and why different events are taking place. So for order flow, you know the catchphrase: study it, analyze it, adapt it. Peace.